I've heard a rumour about SMSFs and the amount that they have to invest per year.
Yep.
There's a percentage on that. Is that correct?
There's no defined percentage that you have to invest, but the ATO did recently write to a lot of trustees about asset concentration. What's happened in this space, and this is a big industry. So there's last year, 30 June 21, something like 598,000 self-managed super funds. 580 or it's 80, 800 billion, 800 billion under management within the self-managed super fund environment, $3.3 trillion industry. So self-managed super represents about 25% of the superannuation balances in Australia. So when there's that amount of money around, that can drive, certain structures to be promoted. So one thing that we have seen is companies will set up, they'll market rental properties in a particular area. They'll have call centres, they'll cold call mum and dad get signed up to buy a property, and then setting up a self-managed super fund. They've only really got $120,000 equity. So they use that $120,000 equity to go and buy a $400,000 house out at North Lakes. Now, those funds, their asset concentration is basically 100% in one asset. So ATO was writing to a lot of these types of trustees that's saying we think you need to reconsider your investment strategy. So they're basically saying that you don't have any diversification. It's not they don't feel it's a great strategy. So the regulator's guidelines really are that you should have about $250,000 as a minimum for self-managed super, 250 to 300, and that's based largely around the fees that are associated with operating self-managed super funds. So you're looking at about 1 to 1.5% generally in fees for most superannuation accounts. The retail providers they're a little bit lower depending on your balance. But with a self-managed super fund, the compliance costs are $2,000 to $3,000 for a standard sized fund that might have $200,000 with some equities and some managed funds and maybe a rental property. You're looking at around about 2.5 to 3, including the audit. So if you look at that as a percentage, it's around about 1%. So if you've got $60,000 and your fees are $2,500 to $3,000 a year, it's not going to take long for that balance to get eroded away. So really, for us, our guidelines, our advice to our clients is it's a minimum sort of 250 to 300, and that's in line with what the regulators are promoting.
So there's no minimum. Just to get back to my question, there's no minimum amount we have to invest per year.
Oh, sorry, I didn't answer the question. No, there's no minimum. You can have it sitting in a bank account.
Right.
It can just sit in the bank account and not do anything. But your investment strategy has to state that, and then there could be argument to say that you're not meeting the sole purpose test because how is that going to benefit your retirement? Not that anyone would do it because you're not getting a return, but you don't have to invest a specific percentage. So if your investment strategy states that you want 40% invested in just an at-call interest-bearing account that generates 1% interest, and then you want the balance invested in could be just direct equities, then that will be compliant. So your investment strategy, which is one of the administrative documents that you need to have in place every year, that outlines where the funds are going to be invested. So as long as your investments meet what the strategy says, then it will be compliant on that side of it. But there's no specific percentage that has to be invested. So it just has to be, it just has to meet that sole purpose test. So it's got to be the funds have to be used for a purpose that's going to benefit you in retirement.
All
so
right.
that's the main test under the Act.
The Proactive Podcast, brought to you by Me Media.